Hello, I'm Ewing and I'm a real estate and mortgage note investor. And in this video, I'm going to break down exactly what the heck is a mortgage note. So many people don't understand that you can actually invest in mortgage notes the same way a bank would and get all of the same benefits that a bank would get, as well as get many of the same benefits that you would get from owning a rental property or investing in the stock market. And so I'm here to teach you a little bit about the basics so you understand exactly what is a mortgage note. And there's actually two different components that make up a mortgage note in the United States. And this also pertains to anyone that is interested in doing owner finance deals, buying houses subject to the existing mortgage that the seller has, and really anything related to the mortgage space. This is important to understand and know. So the two components of a mortgage note are, number one, the promissory note, or just the note, okay? And then the security instrument, which is mostly known as a mortgage in most states, but it can also be referred to as a deed of trust in states like Texas, for example, and even a security deed in states like Georgia. That's the only one I know of that uses a security deed. But these are all security instruments, okay? But let's back up and talk about the promissory note first. So the promissory note, you can think of it kind of as an IOU or like a contract between the borrower and the lender. So it's going to spell out all of the terms and conditions and items that both the borrower and the lender are agreeing on in that transaction. So it's going to list the amount being borrowed. It's going to list the interest rate and whether that's a fixed rate interest rate or an adjustable interest rate or interest only loan or an amortized loan. It's also going to list the loan term length, so how long you have to pay off that mortgage. If there's a balloon payment at any time or you have to pay the full balance at a certain point in the future. It's also going to spell out what happens if you are late on your payments as the borrower or if you're in default, and outlines how the lender is able to foreclose. So it really spells out, it's a contract that spells out the agreement, okay? And this is not something you're going to find recorded with the county deed records, all right? This is a piece of paper that is held on to by the lender. All right, it's something that's transferred when you buy a mortgage or when banks sell mortgages back and forth. It's transferred from one lender to another, but you're not going to be able to find it publicly in most cases. Now, the second document, the security instrument or mortgage, this is what you're going to find recorded in the county deed records at the county clerk's office or the county recorder's office. And this is the document that secures the loan or the mortgage to the piece of property or whatever the collateral is. If it's a car loan, then it would be the car, right? But this is what gives the lender security in making this investment and lending you the money, because this allows them to foreclose on that asset or on that property if you don't pay, right? And so this security instrument or mortgage, it's going to spell out exactly what the lender can do if you default on the mortgage, okay? There's going to be something called an acceleration clause that allows the mortgage holder or lender to basically demand that the loan be paid out. Otherwise, they would start the foreclosure process, and it would also outline what that looks like. It also contains the legal description of the property that the loan is secured to. And basically, it just ties the lender's loan in the form of a lien to the property, okay? So why is this important? Well, if you're going to be investing money as a lender, you want to have your investment secured to a hard, tangible asset that keeps its value and even better, goes up in value over time, right? So if you're a real estate investor, you already understand this, that owning property is a good idea because it's not something that will disappear or lose value overnight. And it's something that everyone needs, right? Everyone needs a house or everyone needs buildings to do whatever it might be, whatever business it might be. We need buildings in order to function as a society. And so investing in those assets is a good idea. But lending on these assets is also a good idea because as the lender, you have control of that asset because of that mortgage or security instrument. And it allows you to get many benefits like monthly cash flow in the form of the monthly loan payments, but also benefits if the borrower doesn't perform, because then you can take back that asset and get value from it that way through either a foreclosure or just taking back the property through that security instrument. Okay, so it's very important, and it makes investing in mortgage notes make a lot of sense because of the fact that you're still secured to real estate, just as if you own the property. All right, so if you have any questions about that, please feel free to reach out to me or post in the comments below if you're watching this on YouTube. And you can contact me. There's also a link where you can actually book a call, and we can schedule a 20-minute real estate investing strategy session, and we can talk about mortgage notes or whatever your real estate investment strategy or wealth goals might be. I'm happy to get on a Zoom call or a phone call with you and just discuss that and answer any questions you might have. And we can also discuss how you can get involved in some of our deals if that's something that you might be interested in. So please subscribe if you're watching on YouTube. Otherwise, thanks for your time. I'm Cal Ewing. Look forward to talking more real estate with you in the next video. Take care.